Yes. In previous classes, we have seen the final accounts of sole proprietorship. To prepare the final accounts of the sole proprietorship, we have crossed so many steps in the accounting procedure. That is, first one, transactions, writing the entries, posting into the ledgers, trial balance, and at last preparing the final accounts. They are profit and loss account and balance sheet. In sole proprietorship, those accounts are related to one person, and if we come to the partnership form, it is related to more than one person, that is from 2% to 20%, from 2 members to 20 members. In this partnership form, the partnership form is formed with the extension of the existing sole proprietary form, or forming a new entity as partnership form. Okay, whatever the case it may be, in partnership account, there must be 2 or more members. Yes. Now let us go. Yes, meaning of the partnership. A partnership form is an association of 2 or more persons to carry on a legal business. Yes, the business must be legal in nature, and it is an association of 2 or more persons and share its profits or losses by them, by the partners, as per the partnership deed or partnership agreement. So, a partnership firm is an association of two or more members. And also, that partnership firm should perform the functions of the business on legal basis. And the profits which are earned from such kind of legal based business should be shared. Either they may be profit or losses, should be shared by the partners as per the ratio prescribed in the partnership deed. The persons who join hands together to do a business are individually known as partners and collectively as a firm, partnership firm. So the members who joined in the firm individually are called as partners. A, B, C, Ram, John, Akbar, like so. And collectively they are called as a partnership form. According to Section 4 of the Indian Partnership Act 1932, the term partnership is the relation between two or more persons who have agreed to share the profits or losses of the business carried on by all or any of them acting for all. Yes. Section 4 clearly says that the business can be carried out by all or any of them, one, two, or some, but those partners who carry the business must act for all. They do the business on behalf of all the partners, all the members. They are the representatives of the firm. So, generally, all these things are mentioned in the partnership deed. So, according to Section 4 of the Indian Partnership Act 1932, it is a relation between the two or more persons, and the business can be carried by all or any of them. Now, let us see what are the essential elements of partnership. Yes, there must be two persons. Must be at least two persons. And all such persons must be competent to contract. They must be competent to contract. For example, if a person is mentally retarded, is he competent? No. He is not eligible to do the. He is not eligible to become a member of the partnership. And if the member is below 18 years of age, that means if he is the minor, he is not eligible to enter into it. This Partnership Act does not accept the entry of a minor into the partnership firm. So, partnership, all such persons must be competent to contract. They only become the members of the firm, partners of the firm. Next. Second one, agreement. There must be an agreement among the partners. That is called as the partnership agreement or partnership deed. So, this agreement, this law, Partnership Act 1932, permits to the members that the partnership deed or the partnership agreement can be written or oral. Agreement can be written or oral. But oral agreements sometimes may not be challenged in the courts if there are no evidences. So, it is advised that if it is in written form, it will be challenged in courts if any problems are arisen in future. So most of the partnership firms make their deeds, their agreements in written. When there are more members, if there are two or three, okay, it may be considered because the understanding may be bit among the members as there are few. But if the members are more, it is advised to be in the written form. Next, legal business. As we have seen in the definition, the business must be on legal basis. The business must be executed on legal basis. This is one of the most important elements, that an agreement should be for the purpose of carrying on the business or profession on legal basis. The business to be carried on by the partners must be legal, should be legal. Fourth one, profit sharing. The agreement between the partners must show the profit sharing ratio. It is clearly mentioned, it should be mentioned in the deed that what is the proportion of profits or losses should be shared among the partners. And if it is not mentioned in that deed or agreement, the profit and losses should be equal among all the partners. Generally, the profit sharing is mentioned. Okay, now we shall move for the fifth point. Mutual agency. Yes, there should be a mutual agency relationship among the partners. It is an agency. Each partner is both an agent and as a principal one, boss. Each person is an agent as well as a principal one, member, owner. Each partner is in the sense that he can bind the other partners by his acts done. So as we have seen earlier, if any act is made by one partner, that act is borne by the all partners in the firm. Whether it is good or bad, whether it is legal or illegal, all should be bound for that action. So the acts which are done by one partner or some partners should collectively borne by all. Next, number of partners. As we have seen, the minimum members of the partnership firm is 2, and the maximum number of partners in a banking firm should be 10. If it is a banking firm, if it do the business with the finance, money, the minimum members are 2 and the maximum members are 10. Whereas in the case of other firms, other than banking firms, the minimum are 2 and the maximum are 20. So The minimum members of the partnership firm are 2 and the maximum members are 10 in case of banking firms and 20 in case of other firms. Now let us see partnership deed. So as stated above, a partnership is formed by an agreement. This agreement can be oral or written, though the law does not expressly require that. There should be an agreement in written, but the absence of written agreement may be the source of problem in managing the affairs of the partnership firm. Yes, as we have seen earlier, even if the agreement is, if it is oral, some problems will be arising. So in the option, it is advised to be in written. Contents of the partnership. Okay, these are the contents of the partnership deed. Sorry, contents of the partnership deed. So now first one is name of the firm. XYZ Limited, XYZ Partnership Firm. ABC Partnership Firm. Ram, Rahim and John Partnership Firm. Or in any other firm. So the name should be mentioned in the deed. On what name you are going to start the business should clearly mentioned in the partnership deed. Name and addresses of all the partners. Should clearly write the full names of the partners and their details, their PAN numbers and the residential addresses of all the partners and any other documents required by the Act, Partnership Act 1932. Third one is nature and place of the business. Yes, what is the nature of the business which is being carried, which is going to be carried by the partners? And where is your firm? Where do you do your business? Should be clearly mentioned. If it is started to manufacture the chips which are used for the computers. It is the nature is manufacture of the chips. And the place of the business. If the business is started in the Malkajgiri, it should be clearly mentioned that the business is carried at Malkajgiri, the premises of Malkajgiri, like that, or ECIL, or Nagar Karnool, or Karimnagar. The place must be mentioned in the deed. Duration of the partnership. Sometimes duration is mentioned. Sometimes duration is mentioned as in terms of years or permanent, forever. So that should be mentioned clearly. How many years does the partnership firm continue? It should be mentioned. Date of commencement of the partnership. It's also. Now today the deed is made. The commencement of that is the commencement of the partnership. Date of the commencement of the partnership. The business can be started as per the deed or according to the convenience of the members, or again their consent, the all partners consent. But the date of the deed should be mentioned. Amount of capital contributed by each partner. So there must be an agreement how much capital should be brought by the partners. One partner may bring 20,000, another partner may bring 1 lakh, or another partner may not bring even a single paisa, but may become the partner even without, because of if he has the technical knowledge, if he has the experience, sometimes we permit him into a firm without investing any amount, and all those things should be mentioned in the partnership deed. And ratio is an important one. Profit and losses sharing ratio should be clearly mentioned, denoted, prescribed in the partnership deed. If it is not mentioned, what happens? The ratio is not mentioned. If the ratio is not mentioned, the profits and losses should be borne by the partners equally. That is the next. Interest on partners and capitals and drawings. Yes. Interest on partners' capitals should be clearly mentioned in the deed, and also the percentage of the interest on drawings should be mentioned. Interest on loan by the partner to the firm. If any loan is given by the partner to the firm, the interest on that should be clearly mentioned, so that in future, while making the accounts, the interest can be calculated very easily without any hesitation. And salary, commission, etc., if any payable to a partner, should be mentioned. Sometimes, generally, the active partners get the salary. Full-time, part-time full-time partners get more salary, whereas the part-time partners may get a less salary. So all the details, salary and commission, clearly mentioned in the partnership deed. Method of computation and treatment of goodwill on the reconstitution of the firm. For example, if any partner enters into the firm, the treatment of the goodwill should be clearly mentioned. If any partner goes out or retires from the firm, it should be clearly mentioned of the valuation of the goodwill, or calculation of the goodwill, or computation of the goodwill. 12th one. Mode of settlement of accounts in case of retirement death of the partner. So, if the partner retires at any time, if he don't want to continue in the firm, or accidentally, if any partner is died, the mode of settlement should be clearly mentioned. So there is a chance to the partners to retire at any time with the consent of the other partners. So in such case, the settlement procedure should be mentioned here. 13. Mode of settlement of accounts in case of dissolution of the firm. Okay. If all partners are decided to dissolve the firm, the procedure or mode should be clearly mentioned in the partnership deed. Okay, now let us see the rules in the absence of partnership deed. Rules in the absence of partnership deed. Yes. If the partnership deed is not existed, some points are not mentioned if some points are not mentioned in the deed. What are the rules in absence of such kind of things? Should be seen now. First one, the partners will share the profits and losses in equal ratio. Yes, if it is not mentioned the ratio, all the partners are entitled to get a share of profit and losses in the equal ratio. Second one, interest on loan will be given at the rate of 6% per annum to the partners. If any loan is acquired from any partners to the partnership need, partnership necessities, needs, and that percentage of interest is not, if the percentage of interest is not mentioned in the partnership deed, the interest should be calculated on such amount at the rate of 6% per annum. And no interest is allowed to partners on the capital invested by them. If in the partnership deed, the interest on capitals not mentioned, no interest is allowed to the partners on capitals. Next, no partner is to get any remuneration such as salary, commission, etc. for participating in the business. If it is not mentioned, no partner is entitled for remuneration, salary, commission. And no interest will be charged on drawings made by the partners. If any partner is drawn some amount from the partnership form, and indeed the interest is, if it is not mentioned, no interest is calculated on such kind of drawings. Yes, what is the meaning of the profit and loss appropriation account? Profit and loss appropriation account is an extension of profit and loss account that is prepared to distribute the net profit among the partners. All adjustments relating to partners like interest on capital, interest on drawings, commission to partners, etc. are made in this account. So all adjustments individually should be mentioned in the profit and loss appropriation. What is the purpose of profit and loss account, appropriation account? The main purpose of the profit and loss appropriation account is to calculate and distribute the divisible profit and loss. The Income Tax Act and the audit rule does not permit the partnership firm to consider the amount as business expenditure which is payable to the partners. So this is the format of the profit and loss appropriation account. Observe the format. See, credit side, profit, and again interest on drawings. Interest on drawings is the income to the firm. Interest on drawings from the partners, so it is the income. Fine fees from the partner, it is also income. See carefully, profit, and second one interest on drawings, third one fine and fees from partners. These are all the incomes. And if you go to the debit side to transfer to reserve, it's okay. We transfer some amount to the reserves, and to interest on capital. Yes, this is the expenditure to the firm. Interest on capital is expenditure to the firm. So all should be made. A partner B, C should all the interest should be calculated on the capitals which are brought by the partner. This is the expenditure to the firm, and partner's salary also it is an expenditure to the firm. Bonus commission to the partners also is the expenditure to the firm. Okay, this is the profit and loss appropriation account. Yes, entries. We shall see entries. Capital contributed in cash. Yes. Cash account at R2. Partners capital accounts. Cash account at R2. Partners capital accounts. When the capital is brought in the form of cash, this is the entry. Cash account at R2. A capital account, B capital account, C capital account, like that. P capital account, Q capital account, R capital account. So names should be mentioned because it is a partnership firm. Cash account at R2. If we already we have seen that in the sole proprietorship business, simply we mentioned cash account at R2, capital account. Capital account means only one person is there, so capital is belongs to that one person. But in the partnership, there are two more persons, so all the names of the partnership are mentioned. Next, share of profits. Profit and loss appropriation account that are to partners' current accounts or capital accounts. And share of losses. Partners' current accounts or partners' capital accounts that are to profit and loss appropriation. See interest on capital, profit and loss account that are to profit and loss appropriation account that are to partners' current accounts. Partners' salaries, profit and loss appropriation account that are to partners' current account. So these entries, you see the previous slides. Okay, so now shall go further. Interest on partners' loan. Partners loan. Yes, okay, we are seeing in this current account of the partners' current accounts. Okay, if it is fixed capital account, simply we mentioned here as the partners' capital accounts. But if it is fluctuating capital system, if it is a fluctuating capitals method, we mentioned as the partners' current accounts. So it is better to understand if it is a fluctuating current accounts should be mentioned. If it is fixed capital account should be mentioned. Yes. Now let us see interest on partners loan. So interest on partners loan entry is profit and loss appropriation account data to partners current. So interest on partners loan is the income income to whom? To the partner, and expenditure to the firm. And partner's drawings is the, see, partner's current account data to partner's drawings account. This is drawings. And second one is that the third one is see, interest on drawings. Interest on drawings is the income to the firm. So partner's current accounts data to profit and loss appropriation. And methods of maintaining capital accounts. The partner's capital accounts are maintained according to two methods. One is fluctuating capital method and the fixed capital method. In fluctuating capital methods, two accounts should be maintained. One is capital account for each partner is maintained, and all the transactions relating to a partner are recorded in the capital account. As in the current account, see, in the fluctuating capital method, only one account is to be maintained. That is capital account. Just as we have erroneously said, that is, in fluctuating capital method, we should mention capital account of the partner. In fixed capital account, we should mention capital accounts and current accounts. So we shall see again clearly. Under fluctuating capital method, only one account, that is capital account for each partner, is maintained, and all the transactions relating to partner are recorded in his capital account. As a result, the balance in the capital account keeps on fluctuating. Now see, this is the capital account. Here balance, see here balance of the previous year capital is here mentioned, and all other entries are mentioned debit side and credit side. At debit side, these are the incomes of the partner, these are the expenditure of the partner. So salary is the income, commission is the income, profit and loss appropriation, share of the profits is the income. And here drawings is an expenditure, interest on drawings and also an expenditure, and profit and loss, this is a loss. So it is a that means it is the aspect which lessens the balance of the capital. So this is, and next in fixed capital method, two accounts are to be maintained. Capital account and current account for each partner are maintained. The transactions relating to introduction of withdrawal of the capital are recorded in the capital account. In the capital account, only the capital is to be recorded, and the other all aspects should be mentioned, should be recorded in the current account. The aspects are salary, interest, drawings, all the commission, etc. See, this is the capital account and this is the current account in fixed capital method. So this capital is fixed. This capital is fixed. So if any additional capital is brought into the firm, that should be mentioned in the capital account. That's all. Otherwise, we should not touch it. It should be continued forever as fixed. So it's called as the fixed capital method. So, and if all other aspects are to be clearly mentioned in the current account. Only in current account, it is all other aspects should be added, but in the capital account, yeah, that is fixed. So these are the differences between the capital, fixed capital and fluctuating methods. See, observe it, and capital remains unchanged except in some special circumstances in the fixed method, and fluctuating always fluctuates in fluctuating method. And two, in this number of accounts, two accounts are maintained. In this, only one account is maintained. Okay. Now, in this, all adjustments, drawings, etc., are to be done in capital accounts. No. It's wrong. It's here wrong. So, all adjustments, drawings, all other things are should be adjusted in current accounts. Adjustments of the all adjustments, etc., are done in current account. In this capital account, fluctuating capital account, in fluctuating capital account. So, like that, there is a, again we have to get an idea that in fluctuating capital, in fixed capital method, two accounts are maintained. One is capital account, another is current account. All salaries, drawings, commission should be mentioned in the current account, and only capital should be mentioned in the capital account. And whereas fluctuating capital method, all capital, including capital, all other aspects should be written. See, in this balance as well as all salary, commission, all others are mentioned in the partner capital itself. Okay, so with this we conclude this class, and we have clearly seen from the beginning all the what is partnership deed, what are the contents of the partnership deed, and what are the aspects if it's not mentioned in the deed, and what is the profit and loss appropriation account, and some entries, and fluctuating method and fixed capital method. Okay, thank you.